Hi, I'm Amy Ford, and I'm going to teach you all the basics for accounting for inventory. Now, inventory is a topic that contains a lot of information for the introductory financial accounting student. So I'm going to walk you through all the basic concepts step by step. We have several topics to cover as we go through the basics for accounting for inventory. We will begin with the two inventory systems, perpetual and periodic. Since both systems require a different series of journal entries to record inventory transactions, we'll go through the journal entries for each one. Then our next topic is going to be the cost flow methods. Now this is an area where some students struggle, so we'll discuss and practice with the different methods. So let's get started with inventory. There are two different inventory systems, perpetual and periodic. We're going to start with the perpetual inventory system. This system is going to be used by entities that require continuous monitoring of inventory. Now, I like to think back to my least favorite class of all time, physics. Like the only thing I really remember from that class is perpetual motion. But that really helps me remember the basics of this inventory system. The inventory account is continuously in motion. Anytime something happens related to inventory, we are updating the inventory account. So in this perpetual system, the entries are going directly into the inventory account. We're going to go through the series of normal transactions for inventory and then how they will be recorded in this video. Now, my students usually find this perpetual system pretty easy to remember because honestly, just ask yourself, is inventory going up or is inventory going down? Inventory is the account that you are continuously updating. As a result of this constant updating, you can simply look at the current balance of the inventory account to determine the amount of inventory on hand at any point in time. Let's review the rules for debits and credits. Inventory is an asset. That means that debits are going to increase the inventory balance. Anytime you say that the inventory is going up, you need to debit the inventory when you use the perpetual inventory system. Credits to the inventory account reduce the balance of the account. So that means anytime that you can say that inventory is going down or decreasing, you need to credit the inventory account in the perpetual inventory system. We're going to go through the series of transactions and learn how to record all the entries for inventory in the perpetual inventory system. Now, in our simple example, we start the current period with no inventory. The beginning balance of inventory is 0. On March 1st, we purchased $8,000 of inventory on account from our supplier. The terms are 310 net 30. Now, we purchased the inventory from our supplier, but we did not pay for the inventory at the time of the purchase. Our supplier has offered us incentive to pay quickly, as the terms are 310 net 30. That means if we pay within 10 days, we can take a 3% discount. Now, if we don't pay within the 10 days, the full amount is due within 30 days. When our supplier offers us a discount, this is called a purchases discount. On March 1st, we need to record the purchase of the inventory. Since we don't know if we're going to take the discount or not, we won't worry about that 3% discount for now. In the perpetual inventory system, remember we are continuously updating the inventory account. So when we make this purchase, we get more inventory. Inventory needs to increase, which is why we are debiting inventory for the $8,000. Now, we did not pay for the inventory. We purchased it on account. Now, this version of on account represents accounts payable. We now owe the supplier $8,000. To increase our liability account, accounts payable, we credit accounts payable. Another common transaction to account for when recording inventory is the payment of shipping costs. The cost of the shipping of the goods from the supplier to our company is included in the cost of the inventory. Now, these shipping costs may also be referred to as freight costs or called like freight in or transportation in. Now, don't confuse this shipping cost with the kind of shipping cost where we pay to ship the goods to our customers. That's a different situation, and we'll cover that in a few minutes. So in this example, we pay $500 of shipping costs for the inventory that we purchased on March 1st. This shipping cost increases the cost of the inventory. So that means we need to increase the inventory account on the books. The debit for $500 is to the asset inventory. Now we paid the shipping cost. What did we pay with? That's right, cash. When we pay cash, the asset account cash needs to decrease. To decrease cash, we credit cash. So there you have our journal entry for this transaction. On March 3rd, we returned $1,000 of inventory to our supplier. This was some of the inventory that we purchased on March 1st. When we take the inventory off our shelves or out of our warehouse, inventory has decreased. So the effect that we need to have on the books is to decrease the inventory account. That is a credit to inventory. Remember, in this perpetual inventory system, we're continuously updating the inventory account. Every time something happens related to the inventory, we're updating the inventory account. Now, this was the inventory that we purchased on March 1st. Now we're returning it. Have we paid for this inventory yet? Nope. Are we gonna have to pay for this $1,000 of inventory that we're returning? No. So to record the decrease in our liability to the supplier, we need to decrease the liability account accounts payable. To decrease accounts payable, we debit accounts payable. Okay, we've recorded several transactions, so now is a good time to review our accounts so we know where we're at. In the accounting cycle, we record transactions in the journal. Then we post to the T account. Here's our T account for inventory so far this month. We debited inventory on March 1st when we made the $8,000 purchase. On March 2nd, we paid shipping for this inventory, which increases the cost of the inventory. That's why we show the $500 debit to inventory on March 2nd. Then on March 3rd, we returned some of the inventory. Returning inventory decreases inventory, which is why we have a credit to inventory on March 3rd. Now, before we proceed with more transactions, let's look at accounts payable. On March 1st, when we purchased the inventory on account, we increased our liability accounts payable with a credit of $8,000. Then on March 3rd, when we returned the inventory, we discussed that we won't have to pay for the returned inventory. Returning the inventory decreased our liability to our supplier. We show that decrease in the liability as a $1,000 debit to the account on March 3rd. So right now, the amount we owe our supplier is $7,000. Is that the amount we're going to have to pay though? Did I get you? That's a trick question. How much we're going to have to pay the supplier depends on the date on which we pay them. Now remember, they offered us that $310 net $30 discount. Now, this is just like a good book where you just can't wait to turn to the next page to find out what happens, right? Is what we've covered so far giving you a better understanding of inventory? I hope it has. If you want to learn more about how to use both the perpetual and periodic inventory systems and how to record inventory using cost flow assumptions like LIFO and FIFO, then click the link below or go to Gleim.com and look for our free basic accounting course in the CPA free resources section. In the course, you'll find other great information on topics such as the details on how to record property and equipment, including depreciation and liabilities, which can really help you in your financial accounting classes. So click below or go to Gleim.com to learn more.